Ladies and gentlemen, welcome to our Candriam and Kartesia Impact Private Debt webinar. Earlier this year, we announced a strategic partnership with Kartesia, and today, July 12th, we will talk about three main topics. The first topic is how ESG is becoming embedded into private debt, one of the fastest growing asset classes within alternative assets. The second topic we will cover today is how Kartesia, a European leader in middle market private debt, and Candriam, a renowned leader in sustainable investments, will work together in this field. And finally, we will discuss how we can achieve a more inclusive and efficient society by investing in companies that directly contribute to the UN Sustainable Development Goals. My name is Renato Guerriero, Chief Sales and Distribution Officer at Candriam, and with me today we have four senior representatives of Kartesia. Kartesia just joined the New York Life family a few months ago. So we have Christina Emil, Senior Investor Relations Associate, Coralie de Maashag, Head of CSR and ESG, Franz Paulus, Head of Investor Relations, and Damien Scayere, Managing Partner at Kartesia. I would like to remind you that you can ask your questions through the digital Q&A toolbox available on the Zoom platform, and we will take them as they come. So let us start with the very first question, and this is more for Damien. Hi, Damien. It's a pleasure to have you here today. And I would like to ask you to tell us more about Kartesia as a company.
Thank you, Renato. So as Renato said, my name is Damien Scayere. I'm one of the four founders of Kartesia and managing partners. So Kartesia was set up more than 10 years ago. And today we manage circa 4 billion euros across four strategies. We have 7 European offices across 6 countries, namely Paris, Brussels, London, Luxembourg, where the funds are based, Frankfurt, Munich, and Madrid. We've been investing across Europe, as you can see on the right-hand side, with 3 main markets. First one is Germany and Benelux, which account for slightly 1/3 of the investment we've made. Then France and Spain. We have a team of 4 managing partners, 3 of them having met at ICG back in 2000. I was Chief Investment Officer of ICG, and I met there with Rémy Prieto and Laurent Bouvier, who are my partners today. And I must say we've got quite a broad experience when it comes to restructurings, not because of Kartesia, but because of our past exposure at ICG, where I had to deal with the global financial crisis in 2007 and 2009. And at that time, we set up a SWOT team to deal with the most complex restructurings. And I must say that it has been quite useful to address some difficult situations that we could have seen afterwards. So today, the platform is managed by the 4 of us. We take investment decisions on a unanimity basis and corporate decisions as well. So today, we are a European debt platform, very much focused on what we call the low mid-market, which are companies for which EBITDA will range between 5 and 20 million euros. This segment is quite underserved, and competition is far less acute than what you could see on the mid-market or higher mid-market. And from the very beginning, we decided to go for a local approach with local offices, people speaking domestic languages, we believe that it's a very strong barrier to entry in our lower mid-market segment, and it's rather impossible to do deals in this segment based in London with a pure international Anglo-Saxon team. So today we are managing 4 different strategies. The flagship one is what we call Kartesia Credit Opportunities. We've raised 3 funds, the last one being KCO5, 1.5 billion euros. It's an opportunistic strategy, which means that we can invest across the capital structure with an expected yield between 13 and 15%. So here we can do primary and secondary transaction. And the yield will be generated by a mix of cash coupon, discount from the sellers when we buy on the secondary market, peak equity, upside returns. These funds are classified under Article 8 for SDF4, and we are raising opportunities with a team of 6 dedicated team members. The second strategy is KSO1, which we've just raised at 1 billion euros. Same target, i.e. the European low mid-market, but here we're gonna do more plain vanilla transactions where the yield of 8% growth will be generated mostly by cash coupon, some peak element and fees. We are doing mostly primary transactions. The fund is well invested, and we'll start the fundraising of KSO2 by the end of this year. We also have a small fund called Kartesia Structured Credit involved in the CLO sub-tranches in which we invest, or in the investment pieces of the CLO market that we do for one specific investor. So it's a team of 3 people, quite successful, which works with the mandates, especially. And then KIF that we will develop further on, which is our new impact fund, for whom the fundraising will take place this year. So these 4 strategies are backed by a very strong team of 18 junior investment members and strong support staff based in Brussels and Luxembourg. We have a very strong track record, and I must say it's a clean one, i.e. it's not an Excel one, it's based on real exits. So on 92 exited companies, we've generated a gross return of 16.4%. And as you can see, this track record is quite consistent, with the bulk of our portfolio generating the expected returns we wanted to achieve. On the next slide, you can find our track record by fund. Once more, very consistent, very sustainable. We are very much focused on consistency and downside protection. And as hopefully you can acknowledge, we've generated strong returns across all the vintages.
Thank you very much, Damien. It's really a very exciting company history, and congratulations for your outstanding performances. Now I would like to understand a little bit more about the impact strategy. And for that, I would like to turn to Franz. Franz, the floor is yours.
Thank you very much, Renato. Good afternoon, everyone. So first, by way of introduction, I would remind the participants to this webinar of the advantages of investing in private debt. So essentially, it offers 2 main advantages. The first one is portfolio diversification with a low correlation to public markets. And the second one is attractive risk-adjusted returns, especially in a low interest rate environment. As such, private debt is a good alternative to fixed income investments. Now, moving on to Kartesia specifically, we have a very differentiated approach to direct lending. And this is based on three main pillars. The first one is a focused positioning on the lower end of the mid-market that we define as companies with an EBITDA that is typically ranging from 3 to 15 million euros. This segment offers a favorable supply-demand dynamic. On the one hand, it includes the largest number of companies in the economy. In the other hand, it is relatively underserved by banks, but also by alternative lenders. The second pillar, as Damien said earlier, is the large network of 7 European offices. This allows us to make deals locally, most of the time with limited or no competition at all. The third pillar is a diversified sourcing model that we have developed over the last 12 years, and that encompasses sponsors and sponsorless opportunities sourced both on the primary and secondary markets. These different channels are generating a large and growing deal flow. The combination of these three pillars just mentioned translates into high selectivity and strong risk-adjusted returns. Of note, on this particular point of returns, Kartesia has just been ranked as the most consistent top-performing private debt manager in Europe for the second consecutive year. Now, moving on specifically to your question, Renato, i.e. impact. So creating the impact debt strategy for us has been a natural step in our sustainability journey. ESG has been a key consideration at Kartesia since the creation of the firm back in 2013, and multiple initiatives have been conducted since 2014. We have designed the impact component of the strategy for it to be authentic and robust. So what we wanted to absolutely avoid was greenwashing. To summarize the key impact characteristics of the fund, first, it will promote a better society on a healthier planet, financing companies whose products and services contribute to the United Nations Sustainability Development Goals, and or whose practices can be improved through impact objectives. Second, it will include the definition of an ESG/impact action plan for each investee company, comprising 2 key impact targets, environmental and social, that will be linked to the interest rate on the loan. If the company meets the impact target objectives, the company will benefit from a meaningful reduction in the interest rate. Third, Kartesia, in collaboration with Candriam, will provide ongoing support to companies to help them reach their impact objectives. And finally, from a regulatory standpoint, the fund will be classified as Article 9 under the EU SFDR regulation. This being said, as with other Kartesia strategies, 2 key objectives will remain: 1, capital preservation, and 2, risk-adjusted returns. As such, the impact fund will not compromise on returns to generate positive impact. The fund will seek 5% gross return, 4% net, while investing in the safest part of the capital structure, i.e. only in senior secured debt instruments.
Thank you very much, Franz. Now I would like to include Coralie in the discussion. And Coralie, you are the leader when it comes to ESG and CSR at Kartesia. And as Franz just said, you have embedded CSR and ESG very early in your company activities. can you describe us how you will implement the impact strategy?
Yes, of course. So first, hello, Renato. Hello, everyone. So I will try to summarize the strategy and how we plan to implement it, because I could talk about that for a very long time. So first, as mentioned by Franz, we selected 2 themes for this impact fund: a better society on a healthier planet. And we really want the fund to promote a more inclusive and environmentally efficient society. We will work with what is called SDG, or Sustainable Development Goals. I guess everyone is familiar, but just as a reminder, those are a collection of 7 global goals designed to achieve a better and more sustainable future. And they were set up in, I think, 2015 by the United Nations. And they are intended to be achieved by 2030. So we selected 9 of those SDG that you can see on this slide. They cover various sub-themes such as gender equality, education, lower carbon economy, etc. We explain on the next slide how we will identify companies that we will contribute to the 9 SDG selected. So first, on this slide, we will see that, of course, we will first have a negative screening, such as we do for our current funds. We will exclude obvious sectors such as weapon, tobacco, gambling, and so on, the one that are most of the time excluded. Then we apply a second filter that will exclude additional sectors such as coal, but also more importantly, that will exclude companies that do not pass the first layer of ESG due diligence performed by Kartesia. And this second filter will help us to identify 2 types of company that we can see on the right side of the slide. First, companies whose product and services directly contribute to the 9 SDGs that we selected. And secondly, companies with the potential to improve on ESG, such as, for instance, to improve on carbon emission or diversity. And therefore, those companies are able to contribute indirectly to the 9 SDG. And actually, by indirectly, I mean not through their products and services. We expect less than 50% of our investment to be classified in this second category. Actually, much less. We will try to reduce the amount invested to a minimum, as it's, of course, there that the risk of greenwashing is the more important. And as Franz mentioned, it's really our top priority to avoid this greenwashing. Note that we will also have an impact advisory committee in order to discuss any potential contentious investment, and the committee will be made of 4 members, 2 independent members, 1 senior ESG in charge at Kartesia, and 2 independent members. On the next slide, we see then how we plan to contribute to the 2 impact team. So once we have identified a company from one of the 2 categories that I just mentioned, so whose product and services directly contribute to the 9 SDGs selected, or with the potential to improve on ESG and therefore to contribute indirectly to the 9 SDG. Then next to the usual business and financial due diligence performed by our Kartesia team, the ESG due diligence team of Kartesia will perform a full ESG due diligence prior to investment. We will not close any deal prior to getting their full ESG due diligence report. And then after due diligence, and that's the impact tool column on this slide, we will create a full ESG improvement roadmap, so a plan including 2 KPIs. This will also be done with the support of Kartesia, and the 2 ESG KPIs will be specific to each company. So based on its sector, its own specificities, and so on. They will be linked, of course, to the 2 objectives of the fund, 1 KPI linked to a better society and 1 KPI linked to a healthier planet. And the goal of the action plan is really for the company to improve in terms of CSR and ESG. We really want an added value in this impact fund. So not only measuring KPI, but also helping the company to go to the next level in terms of sustainability. And then finally, the last column is the holding period during which we will monitor the KPIs. So the two KPIs will be linked to the interest rate margin, meaning that if the company meet them, they will have a discount on the margin they pay to us. And the assessment of those KPIs will be done by a third party. And the KPIs, as I mentioned, that are linked to the margin will not be common to the fund. They will really be specific to each company to be sure that they are the most relevant KPI for that business, and to be sure that those are really relevant. On the next slide, we really summarize the incentive mechanism that we plan to have for the impact fund. So, as I said, the portfolio company may benefit from a discount, and actually this discount is up to 50 bips if they meet all target KPIs. This 50 bits we are proposing is quite high. Market is more at 5 to 10 bips, but we wanted to go higher to really incentivize the company to reach the ESG targets. And also, as mentioned previously, we want a real added value to this fund. So there will be other tools next to this impact incentive mechanism. And we can see on the next slide those various tools. First, as I just mentioned, we plan to offer an ongoing support to our portfolio companies. So we will provide them an expert support. We will share our knowledge in terms of best practices and resources. We will maintain an ongoing dialogue with the management. All this with the KPIs and the improvement plan. As you can see in the second column, and I also already mentioned it, we plan to have an impact advisory committee. And this committee will really help ensuring the robustness of the impact targets and provide support to borrowers. And finally, the third column, we will really report in a very transparent way. We already significantly improve our CSR and ESG reporting since January. We included, for instance, an ESG and SFDR section in all our quarterly report to our investors. And last month, we published our first sustainability report, which is quite complete and give a full view of our CSR and ESG work. And of course, next to that, we will have an impact report dedicated to our impact fund. I think this gives quite a good view of our new impact strategy and its implementation process. We are very confident about this strategy for several reasons. The first one would be regulation, as regulation is becoming more supportive of a sustainable and impact strategy. I mean, we all heard about SFDR, for instance. By the way, as mentioned by France, this fund will be Article 9, so a dark green fund, the highest level in terms of green according to this new regulation. Another reason why we are confident with this new strategy is that we are moving to a market where if you're a company that is not really embracing ESG, accessing debt will cost you more. And this is how we see the market in the future. And our portfolio companies, they know that. We can already notice in our current fund that they are willing to improve on ESG right now. So actually getting an incentive to improve will for sure be efficient. And finally, of course, getting the expertise of Condriam definitely makes us comfortable in the fact that we will successfully and actively contribute to generate impact.
Thank you very much, Coralie. This is really exciting to see how you have been thinking about the details of the whole analysis and the KPI setting for all of the companies you will invest into. Maybe, as you mentioned, Condriam, in a few occasions, I just wanted to understand a little bit how you will work with Condriam. Is it more on the philosophy? Is it more on the implementation? Or is it on both? How will this happen?
It's actually on both. So Condriam and Kartesia entered into a partnership end of last year. Since then, not taking the impact fund into account, we already collaborated on several topics. For instance, our deal team and ESG teams are following the Condriam Academy. Our communication teams exchange on a regular basis. Our Kartesia for Women initiative also brainstorm with the head of HR at Condriam. as actually you have an equivalent initiative. So we are really aligned in terms of values. And regarding the impact fund, the deal will be sourced by the Kartesia team, but Condriam will be performing the ESG due diligence. So as I mentioned, there will be two rounds of ESG due diligence. A first one, quite fast, just to confirm that Condriam specialists agree that the deal could fit for the impact fund, and that no red flag has been identified in terms of ESG. And then a second round that will be more like 2-3 weeks of work in order to do a full ESG due diligence. Of course, as Condriam will be performing the ESG due diligence, our two teams will also be collaborating on the selection of the two key KPIs linked to the margin and to the improvement plan. And of course, they will be present at the Impact Advisory Committee. We already, since the beginning of this year, we have a regular bi-monthly call to discuss the impact fund processes and operation. And we are also working on various case studies. Collaboration is going great. And I firmly believe that combining actually Kartesia differentiated direct lending approach with the Condriam sustainability expertise will be a success.
Thank you very much, Coralie, for explaining this more in detail. Now I would like to see what the companies you invest in will look like. And for this purpose, maybe it's really the best option is to turn to Damien, who's really at the helm of this fund and Kartesia when it comes to investments.
Yeah, maybe we can go to the slide before this one. It shows the work we've done, thank you, on our deal flow. As you probably know, we review a lot of transactions per year. Due to our business model, we do a lot of small transactions. So by definition, we need to see a lot of opportunities to decide which one we want to finance. And on this basis, we've reviewed 219 deals that could be potential deals for the impact fund, i.e. excluding CLOs, retaining only primary transactions and so on. And we've applied our filters to these eligible deals. And at the end of the day, we've realized that 86 of these potential transactions could be booked with in the KIF fund, which means that based on our existing deal flow, we have the market there. And to be frank, we are quite comfortable that we'll be in a position to invest this fund quite smoothly. The market is very deep, especially for this kind of returns. Here, we're going to target the, I would say, the bulk of the market. And answering the first question that has been raised, how deals will be allocated between KSO and KIF. Actually, these two funds do not target the same risk return. A KSO is 8% gross return, while a KIF is more around 5% gross returns. And the gap can sound low, but actually it's not low at all. It's 50 more expensive to work with KSOs than to work with KIF. And when you are approached by an advisor, usually he knows what kind of return he could expect from his lenders. And we don't see a real gap, a real overlap, sorry, between the two strategies. In the private industry world, these are two real different universes. KIF will be more competing against banks, against seed tranches, senior bullet tranches that we aim to replace. So for deals that are much safer with lower leverages between 3 and 3.5 times EBITDA, that could be funded by banks. We believe that we have something more to add in terms of speediness of execution, flexibility, we're quite convinced that there is a very deep market for KIF. So we've given two examples afterwards. The first one to show you what kind of companies we could finance. The first one, actually, we have financed it through KSO1. As you can, it's a CC Grouper, which is a German recycler of waste. Actually, it's a leading slag recycling company in Germany, which fits our KIF strategy because it obviously targets a better, healthier society through the circular economy. So here it's an obvious candidate, and the two impact targets that we could have retained on the next slide could have been. So the first one could have been the accident frequency rate to reflect a better society. And the second one is obviously the recycling rate, because they recycle waste, which is then used for other purposes. And it could have been the second impact target, based on which the margin would decrease by 50 bips. So this is a good example. We financed this transaction with KSO, and since then it has been refinanced, but we could have refinanced it with KIF now that the leverage is even lower than it used to be. And the second one is a company called SAS that we financed through KSO, but with a higher leverage than the one you can see on this slide. So it's a Spanish company providing biostimulant solutions to improve profitability and the quality of crops. So obviously here it's a company for which it directly targets a healthier planet. So we could have booked it in KIF as well. At the end of the day, it has been refinanced. It has been financed with KSO1, with, as I said, a much more levered company, a much more levered solution. But the company was also open for lower leverage with a lower pricing, so it could have fitted KIF as well.
Thank you very much, Damien. This is very interesting, because we could almost touch the kind of companies you would like to invest in, and this can really have a positive impact, as you mentioned, on circular economy, on sustainability, on things we are seeing every day in our lives. Maybe you mentioned before, Kartesia is very much oriented to capital preservation. It's a company who's been performing in a very consistent manner. And we all know we've been through a very big pandemic with a lot of disruption across many sectors, even though there's been a big difference among sectors. Can you tell us a little bit how come you have been so resilient over the COVID-19 crisis?
I think part of the answer is that our focus on downside protections, which means that in all our transactions we have covenants. We have securities at work, and in certain jurisdictions a share pledge is not enough. We perfectly know that, so we go for a fiducie or a golden share or alternative mechanism. Second, I would say that we went through multiple crises in our past life, especially at ICG, and we know how restructuring works. We know that there's a huge difference between what you can see on a term sheet and what really works when it comes to execution. And we've taken it into account in our structurings. Additionally, in most cases, we are the sole lender. We don't like syndications. We don't participate in syndications. So which means that we are the only decision maker when it comes to credit decisions to be taken. So we are more credible towards all the parties. We can react very quickly. We always keep dry powder to support a company if needed. We are not afraid of taking control. We don't like to do that. We don't want to do that. We're not looking to do that. But sometimes we have to, and we do it. So far, each time we've taken control, we've been successful in restructuring the company. Not always, but quite often when the company underperforms, shareholders have something to do with that because they've been shy with management, because they haven't been brave, because they had no money to support the company, because they were, I would say, focused on their internal issues. So we take a fresh view. We incentivize management. As I said, we can re-inject money if and when needed. And I would say that lastly, we've avoided I would say the all four sectors that have suffered a lot. For the last 3 years, we haven't invested in B2C, retail, apparel, kitchen appliances, all this stuff. We decided to walk away because I know from my past experience how these sectors do react when there's a crisis. And we were not exposed or very lightly exposed to the tourism industry, to the catering industry and so on, which has suffered a lot. We have some situations, maybe 2 or 3, but globally the portfolio was very well constructed, a lot of diversification. I think it's the best security you can have, to be highly diversified, and it's quite an obsession as far as I'm concerned. So yes, as a part of, I think, experience, as a part of wisdom, as a part of luck as well, of discipline. And at the end of the day, we're gonna go through this crisis, probably be stronger than before. KSO5 and KSO1 will be exceptional funds. So far, so good. Of course, everything has still to be done, but if you look at the numbers, if you look at the NAV, if you look at the current trading, I think these are going to be good funds. And KIF will be another good fund. I hope so as well.
Thank you very much, Damien, especially your magic formula that you just mentioned, experience, diversification, and process. Probably it's really what's behind your great success. Maybe I will go back for a minute to Coralie, because you mentioned a couple of times your fund is Article 9. So we all know, that Article 9 funds have a very positive impact. And maybe you can tell us a little bit more how you have handled SFDR with this strategy.
So first, to how we handle SFDR globally at Kartesia, we exchange a lot with our peers and with the external consultants, mainly to be able to understand properly this new regulation. SFDR has not been drafted by private equity and private debt players, so it's sometimes subject to interpretation. We notice actually that for some private debt and even private equity players, this was quite of a painful exercise, but on my side, I see SFDR as something quite positive, despite the high level of reporting work. I see this as positive because at Kartesia, sustainability has always been core to our investment and to our own activities, with ESG embedded at all stages of the investment process. So I see this new regulation as coming to support our ongoing ESG efforts, as we were able to classify our current fund under Article 8, or Article 8 means green funds. So we are comfortable saying that they promote actually environmental and social characteristics, and our new impact fund indeed will be classified as Article 9 or dark green fund, as its objective is clearly sustainable investment. So as Franz mentioned, this is really the next natural step for us. And as we are going one step further, it was logical to build a fund that could meet Article 9 requirement. So it's only the beginning, but regarding the implementation of SFDR, we already implemented several actions to meet the new SFDR rules and regulation, and also to prepare for Article 9. Of course, we exchange a lot, as I mentioned, with our peers. Also the one who have already Article 9 funds, we exchange a lot, of course, on that subject with Kandriam, also with our lawyers and with specialized ESG consultants. Another point is that I have been appointed full-time on CSR and ESG subject in January of this year in order, amongst other things, of course, to be able to oversee the transition to this new regulation. From this year, we are publishing a very complete sustainability report. We have issued it publicly last month. And while doing this sustainability report, we already brainstormed on the impact report that we will be issuing for the impact fund, and that will include all the SFDR mandatory requirements. Also, we added for current fund ESG and SFDR reporting in our quarterly report to our LPs. Another point that we did is that we integrated SFDR indicators, what the regulation call a principal adverse statement, in the investment due diligence process through a fully review ESG questionnaire. Again, we, of course, updated our ESG questionnaire according to SFDR for our current fund that are Article 8, but we also already brainstormed with Kandriam on the ESG questionnaire for the impact fund. So it's a bit more detailed, as this fund will be Article 9. And our legal team also updated our risk management process to reflect the new SFDR monitoring performed. And they also updated our remuneration policy to add a sustainability component. So maybe to summarize, the implementation is going well. And while implementing for our Article 8 funds, we at the same time already brainstorm on Article 9 in order to be ready. And for the moment, everything is under control, especially thanks to the support of our lawyers, our legal team, Kandriam, and the consultants that are helping us on that matter.
Many thanks, Coralie. And you will be on the investment team of this on this fund. And what we received as a question from the Q&A digital tool is a question about engagement. How do you expect engagement with your invested companies be? Do you expect it to be tough, easy, to identify the KPIs? It would be great to have your opinion on that.
We expect it to be easy, actually, because as I mentioned, we already start to engage with our current portfolio companies. So from our KSO and KCO strategy. So up to very recently, we were really focusing our ESG work mainly on the due diligence phase, because we are lender, not owner. So it's always during the due diligence that you can take the opportunity to request changes, to request, for instance, the fact that they should fill in our ESG questionnaire, because after, during the due diligence phase, again, as I mentioned, as we are not owner, sometimes the access to management is complicated, and so on and so on. So before, until very recently, we were really focusing on our ESG work on the due diligence phase, but now we are also working a lot during the holding phase, because we noticed that our portfolio companies are really willing to improve on CSR and ESG. The one with who we already discussed, because we launched a plan to actually contact each of our portfolio companies to have that discussion. But the one with who we already had this ESG focused discussion confirmed to us that they are aware and that they now realize how complicated it will be for them in 5 to 10 years to more 5 for me, but sometimes more 10 for them, to borrow money, to hire a new joiner, because those topics are super important for millennials and even for the next generation, what we call Generation Z. They realize that it will be complicated to get, for instance, an insurance, as they are really aware that portfolio companies that will not work on ESG might not survive in a mid to long term. They are actually happy to have us helping them already to find consultants, to give them best practices. So as I can see today that in our current funds, they are happy actually to have our help. I'm sure that with the impact fund, they will be super happy because on top of that, they will have a discount on the margin. So I don't expect engagement to be complicated in this upcoming fund.
Thank you very much for your perspective, Coralie. And now I would like probably to go to France to understand a little bit the launch of this strategy, how this will look like. And as we heard, you've been extremely successful over the last 18 months with your KSO and KCO strategies. And maybe you can tell us a little bit more about who are your LPs and what kind of players are there and where they come from. Over to you, Franz.
Sure, thank you very much, Renato. Are you, just one question, you're talking about investors, is that correct?
Yeah. I'm talking a little bit about the plan. So when you will launch the strategy, you are more familiar than I am, and also a little bit about your investors.
Sure. So in terms of target size, we are looking to raise 500 million euros with a hard cap at 1 billion. The 500 million mark would allow us to achieve a level of diversification that we seek for this type of risk profile. Above that would be even better, of course, because we will be able to make more investments. In terms of diversification, we are seeking about 25 deals before recycling, before the reinvestment year, and probably 30 to 35, including reinvestment. In terms of timeline, we are planning to hold the first closing in the last quarter of this year, and the final closing at some point in 2022. So then regarding the investor base, the types of investors that are interested in this type of strategy, we already see a lot of interest from insurance companies, pension funds, and to some extent from endowments and some asset managers. Generally speaking, our investor base is made of 65 to 70% of insurance companies and pension funds. And we do expect very strong backing from existing investors in this new strategy. To give you some perspective, the existing investors in our Credit Opportunities funds contributed over 1/3 of the KSO strategy. From a geographic standpoint, our investors are essentially European. They represent about 85% of the investor base.
Thank you very much, Franz. I was just checking if there is a few, we have a few more questions coming in through the digital toolbox. And the question I have is about the minimum investment ticket. Can you tell us normally how it works?
Sure. So this is at the discretion of the GP, the manager, but typically we accept tickets of a couple of million euros. So the average ticket in our funds is 25 million euros, but we do have institutional investors investing 3 to 5 million euros.
Okay, thank you very much, Franz. I believe we have answered all of the questions that came through the digital toolbox, and I really want to thank you all, Coralie, Christina, Damian, and Franz, for your time today, for shedding a lot of information about this new strategic initiative, Impact Private Debt. Of course, we at Candriam and colleagues at Kartesia will be delighted to give you more insight and to reply to your queries. So I wish you now all a very enjoyable summer break, and I look forward to speak to you soon, right after the summer holidays. Thank you, all of you, for joining today.